Right now, the world believes there is plenty of silver. Charts say supply is stable. Vault reports look reassuring. Prices look calm. But those signals rely on one assumption, that reported silver actually exists and is unencumbered. That assumption is false, because much of that silver has already been promised more than once. Most people believe silver supply is simple: mined, refined, stored, sold. But global silver markets operate on claims, not metal. Those claims are traded, lent, and reused. This system works only as long as no one asks for delivery. Silver does not need to disappear for it to be unavailable. There is a market almost never discussed publicly: the silver lease market. Here, large holders lend silver to bullion banks. In exchange for yield, the silver leaves the vault, but the owner still records it as an asset. On paper, leasing looks efficient. Idle metal earns yield, markets gain liquidity, prices stay smooth. But there is a hidden cost. The same silver now supports multiple claims. This is how abundance is manufactured. And here's the problem: leased silver is rarely returned quickly. And when demand spikes, everyone believes they own the same metal. That's when the illusion breaks. Silver leasing does not begin with deception. It begins with trust. Trust between large holders and bullion banks. The largest silver holders are not traders. They are institutions: central banks, sovereign funds, large custodians, industrial stockpiles. These entities rarely sell, but they lend. Leasing keeps silver on the balance sheet, even after it leaves the vault. Here is the critical step. A bullion bank borrows silver at a low lease rate, often near zero. That silver is then sold into the market. Not stored, not reserved, sold. This is where perception breaks, because the original owner still counts the silver, and the buyer believes they now own it. The system survives because most silver claims are never settled physically. They are rolled, offset, cash settled, as long as no one demands bars. The illusion holds. Silver leasing depends on silence, but silence breaks when industrial demand spikes, when trust erodes, or when one major holder asks a simple question: where's my silver? Up to this point, silver leasing sounds manageable. Metal is lent, markets stay liquid, prices stay calm. But this is not work. The risk lives. Rehypothecation is a technical word for reuse. It allows a financial institution to use the same asset as collateral more than once. One bar, multiple obligations. Nothing illegal happens here. Everything follows contractual rules. Leased silver does not sit idle. It underpins futures contracts, exchange inventories, ETF backing, OTC derivatives. Each layer believes its claim is primary. See, they cannot all be right. This is how phantom supply is created. Without mining a single ounce, rehypothecation works because demand for delivery is low. Most participants trade exposure, not metal. As long as positions are netted, physical settlement remains rare. Stability here is conditional, not structural. Now consider the implication. If even a small percentage of claim holders ask for delivery, the system does not bend, it breaks. And when it breaks, someone learns their silver was never there. Financial systems do not collapse when prices move. They collapse when confidence breaks. In the silver lease market, confidence is tested only one way. Stress begins quietly. Delivery requests take longer. Settlement windows expand. Contracts roll instead of close. Nothing is announced, but behavior changes. Delay is the system's first defense. When metal is unavailable, cash is offered. Premiums increase. Incentives are added. Anything to avoid moving bars. Most accept, because few expect a shortage. Cash settlement preserves the illusion, until someone refuses. When pressure rises further, allocation begins. Strategic clients are prioritized. Industrial users receive supply. Speculative holders wait. Retail is last. This is not a market decision. Well, then, it is a policy decision. At this stage, the silver has not vanished, but access has. And once access is controlled, price becomes secondary, because the question is no longer, how much does silver cost? It is, who is allowed to have it? When paper claims fail, markets do not panic immediately. They reprice quietly, and the repricing is never uniform. When silver cannot be delivered, someone absorbs the shortfall. It is never the system. Losses flow downward, from institutions to funds, from funds to participants, from participants to trust itself. This is why confidence matters more than price. These events are not announced, they are managed. Through settlement changes, rule adjustments, quiet disclosures, the narrative remains calm, even as structure shifts. Silence is not stability, it is containment. Silver was never just money or an investment. It is an industrial lifeline, quietly supporting systems that cannot pause. That is why control matters. The silver lease market did not fail today. It functioned exactly as designed, to distribute risk without visibility. But systems built on confidence are vulnerable to awareness. If you want to understand the mechanisms shaping power before they surface, this channel exists for that reason. What if you could recognize the next structural shift before it becomes unavoidable? Comment your thoughts, and don't forget to subscribe for the next revelation.